My name is Marissa. I am a loan officer with the Nevis Team Lending and assistant team lead for the Keller Williams California Premier offices. And I have been a preferred lender for CalHFA for a long time, a very long time. And last year, this program rolled out. It was amazing. And it was gone in a whole 7 days. 7 days. And California has really been trying and doing its due diligence for first-time home buyers. I don't know if you guys know this, but majority of people looking to purchase homes are actually first-time home buyers in the Central Valley region and the Bay Area. So that's really exciting. But it's all about education, and that's why we're here. We're here to bring you the knowledge to help teach you about how to make homeownership affordable in California. And I am very grateful to be bringing one of my business partners in to talk to you guys a little bit more about this amazing program that we offer. In case you don't know, I have been sick with the flu for the last week, so I've got about 5 minutes of talk power before I have coughing attacks. So my my account executive that I work closely with CalHFA is going to be presenting today on the specifics of this program. And here's the thing, you guys, this program is not going to be qualifiable for everybody, right? There's guidelines, there's certain rules we're going to go over, and that's okay. You want to know why? Because homeownership is still an option. You just need to know what kind of programs that you have out there. And there's always got to be an option B. And if you don't think there isn't, well, there is. And so there's hope. So as we're going through this, if you think that you hear something that triggers you that you're like, oh, no, this program's not going to work for me, or it's not going to work for my client, that's okay, because Frank's going to tell you a little bit about some other programs that we have that you might qualify for. And if you don't qualify for one of these, guess what? I've got hundreds of other loan programs that we can look at for you as well. So it's all about that roadmap to homeownership and getting you there. So without further ado, Frank, my friend, take it away, and I will jump in as needed.
All right, great. My name is Frank Burrell, and I've been with Sierra for a little bit here. And Sierra's been doing loans for over 30 years, and CalHFA is a big portion of what we do. And you know, we're experts at this, so we're very comfortable with this programs and helping you guys out. And it sounds like we have real estate agents and borrowers on this call, right?
That's correct.
So now, Marissa, are you going to maintain the chat and just let me know if you get questions, or is
you got it? I'm all over it for you.
Okay, great. And then are you going to just go ahead and flip the slide whenever you're ready to? Can you do that for me?
We got it.
Great.
They
So
see the
yeah, I will say, you know, Sierra is the #1 CalHFA wholesale lender in the state. And, you know, it's great working with Marissa's team because they're very knowledgeable and they're here to help you at all times. So they're going to work through us and on the back end, and, you know, she's awesome and you guys are in good hands with her. So let's go to the first slide. All right, great. So a little bit about CalHFA. You know, CalHFA, you know, we have the Dream for All program that we're going to talk about, but we're also going to talk about the My Home program because everybody's not going to fit in the Dream for All, and we want you to have a lot of options. And we want the agents to be able to communicate these options to the buyers. And the buyers, you know, don't stress out if you don't understand some of the mortgage terms in this, and it's okay. You know, you've got Marissa and her team you can communicate with and ask further questions. But I want you to just get some basics on some of the math and how things work with this program. You know, one of the reasons why we are one of the top lenders with this stuff, you know, and this is important for the agents, because I know sometimes it's hard to get your offers accepted. And, you know, with CalHFA, we're very good at executing these. They come in all the time. I see them, you know, really don't stop coming in. The state does anywhere from maybe somewhere around 800 to 1,100 of these a month. So, you know, these are very popular with the buyers out there. So we're quite comfortable closing these in escrows under 30 days. So with that, you should be comfortable with Marissa and her team and making sure you meet your close of escrows. I just some basics. I don't, you know, especially since there's agents and borrowers on this call, I wouldn't be too stressed about knowing all the basics of the loans and all that stuff, because generally there's like a conventional loan that goes with these programs or an FHA loan. And, you know, with the regular My Home, it's 3% down that you're getting from the state. And for the FHA, it's 3.5%. And then if you move into the Dream for All, you're actually getting up to 20% down from the state. So, which is great, right? Awesome program. So with that, let's go ahead and switch to the next slide. Great. So generally speaking, most of these programs are for first-time home buyers. Now, the Dream for All has added restrictions because it has a more precise area that it's targeting. But with the general My Home program, it's for first-time home buyer. And the first-time home buyer definition is somebody who hasn't had a home in the last 3 years. And there's some variances that you may run into with that. And so Marissa can go over those with you. But generally, you haven't had a home over the last 3 years. Now, CalHFA really wants to help new buyers get in a home. So you won't have like you can't be like on title only with these loans. You'll both want to be on the loan if you're going to do it and be on together. There is some income limits for this per county, but the regular My Home program is a little bit more flexible than the Dream for All, and I'll go over that in a sec. And you can actually, with the My Home program, you can get in, if you're in one of the counties that offers high balance loans, you can do those as well. And so I see a lot of those with the FHA My Home. So we'll talk about that too. Generally speaking, with the My Home program, which is the 3 or 3.5 from the state, that program will go down to a 660 FICO for the conventional if you're in the low income, or for the FHA version, it'll go down to 640 FICO scores. These loans follow like an AUS for DU. We're not running Freddie Mac on these, so they'll follow DU. And in most cases, you'll want to have 2 years worth of income on these transactions. With the Dream for All, sometimes since you're getting a bigger chunk from the state, you may be able to help the self-employed borrowers with 1 year's tax returns, because I did receive some of those on the first round. So that is possibly an option. Again, get with Marissa to work those fine details out. And then generally speaking, with the My Home, if your FICOs are really good, you can take your debt to income up to 50%. If you're kind of like moderates with your FICOs, you can go down to 45 DTI. And again, stuff you don't have to memorize or know, but Marissa will walk you through on that. There's some first-time home buyer courses that you'll take. There's some you can take in person, or you can actually take, which is the most popular, maybe 80 or 90%, take the eHome class, and you can do that online at your own pace. The Dream for All course does have an appreciation feature to it, and they do ask that you take that course, and they even like for you to take the course kind of when you get started if you want, because some people may get into the transaction and may not like that they're giving back some appreciation to the state. So feel free to take those classes early if you want. They're good for a year. And you can do these loans with single families, condos, or even with manufactured homes. And some of the eligible borrowers are US citizens. You can do with green cards, with visas, even DACA borrowers are eligible with this program. I'm going to stop for a sec. Do you have any questions, Marissa, so far? We're good? Cool. Let's go on. Go. Question? You're muted right now, Marissa.
We're good. Yeah.
Okay, cool. Let's go to the next page. So let's go into, Marissa and I were talking about this before the call, and we want you to kind of be aware that there's a lot of options. And I was telling you about like 800 to 1100 of these My Home mortgages get done a month. And that's the standard CalHFA program that's been around for a long time. There is a program called the Equity Builder, and it comes out every couple of years. And when that comes back, Marissa will get you on another call and dial y'all in for that. But the one that we have right now that's got a lot of legs and never really stops is the My Home. And that one is where you're getting 3 or 3.5 from the state. And you can see by the right, it's very flexible income limits, for Sacramento County, it's fine. You can look and see your county in there. And so you can get into, Marissa, what kind of sales prices are you thinking with this stuff?
Well, the average loan amount from last year was around 600 to 700,000 that we saw. Most people wanted that 20% down, but for Sacramento County, San Joaquin County, the average purchase price is anywhere from 500 to 600,000.
Great, that's good. And so you got a kind of a feel of where is the hot spot for this kind of stuff and qualifying. Now, these loans you're getting 3 or 3.5 from the state for the down payment, right? Now you can also get, and that's called the My Home loan. You can also get a third mortgage, which is called the ZIP. That's a 0 interest percentage, and you can get up to 3% for closing costs as well. And with this program, the second on this one is a little different than the Dream for All. The second and third on these mortgages are silent mortgages, so they'll be there on title until the borrower sells or refinances, and then they'll become due. And the reason why the My Home is so popular, because it only collects simple interest at 1%. So let's say you bought a $500,000 house and you got a $15,000 conventional, first with it, and you did the $15,000 second, and you went to My Home, and it's accrues simple interest at 1%, which is great. Let's say you sold after year 2, you're only paying $300 in simple interest after year 2 when you sell that house, which is very low, on that money that you're getting. So very popular program because of that. The third mortgage, which is silent as well, is called the ZIP, and that's zero interest percentage that's accrued on that. So when you sell, you'll pay off that first and second, and the simple interest on the second. They're 30-year fixed mortgages. They're not forgivable. And the borrowers, if you have the ability to pay on those monthly, you can do that. They don't stop you from doing it. The servicing will take your funds. So that is okay as well. And you can, contribute your own funds. So maybe you wanted to just get the 3% from the state and maybe provide 2% of your own funds for to bring it to 95% and maybe improve your mortgage insurance. That is an option as well. So any questions with that before we jump into that's the one program I think that you can really take advantage now. It's there, and not a lot of people are going to fit into the Dream for All. And this is going to be a viable option, and you can get into a home and with very little funds, out of your pocket.
Yeah, this program right here, you guys, is very popular. It's been around for 40 years, long time. And they've constantly have funds available. So funds are not running out on this program or expected to run out anytime soon for it. Student loans affecting the client. Student loans vary depending upon conventional and FHA guidelines. So they go off of the first mortgage. So what we'd have to do is look to see what their student loan payments are when qualifying to see how much of a payment that we have to hit them with. Student loans do come into consideration when we're looking at debt to income ratios for any program out there. But a lot of people get discouraged by student loans. When we look at it, though, there's certain things that we can do, which is a whole other topic in talking and negotiating with student loan agencies. So I can talk to you a little bit more about that. Maybe I'll even set up a whole class just on student loans and workarounds for those, because those can be disheartening sometimes and not very motivating. But this program right here, you guys, for the down payment assistance is very popular. CalHFA, out of all of the programs out there, whether there's programs for teachers, firefighters, first responders, all of that. What I love most about this program is even though you have to pay it back, the interest rates are very, very competitive. They're a lot lower than the other programs that are out there. They do have the limitations on the debt to income ratios, but you're paying so much less in interest that you'll qualify for more. So it's more affordable. And on top of that, we're able to do additional things like buy downs, temporary buy downs, right? We can even buy down the interest rates on these types of programs as well, but the rates are very competitive on these.
Yeah, perfect. Marissa, you nailed a lot of the key points with this program. Additionally, the thing with CalHFA versus other DPAs that you may see out in the industry is its effectiveness and efficiency. You may do, a local down payment assistance program, and you may look at 45 to 60-day close and have to provide 3 years tax returns and 6 months bank statements and stuff like that. And it can be quite painful. This program is very efficient, and you can meet your close of escrows, even the Dream for All. It's in a very efficient program. So let's jump into that. Okay, great. So I'm going to give you a little bit of background. There's been some of you may or may not have sat in on probably 7 hours worth of videos from the state, and there's a lot of information about that because it's great. I like to walk, and so it's been great to listen to those videos when I walk. I take some notes on my phone, and then I put them into my PowerPoints and validate the information with our underwriting team. And so there's a lot of information you'll see on how the state's looking to help for this phase 2 of the Dream for All. The phase 1, was a huge success, but a lot of people weren't super prepared for it. And to Marissa's point, it didn't last very long. So, the people that were prepared, and that's why we're doing the call now, is so that you guys are going to be prepared and have the best opportunity with this program this time around. I'm going to start off with just giving you some basics, and then I'm going to open it up to some questions, because this is the big difference. Because I told you in the last couple slides that a first-time home buyer definition is haven't owned a home in the last 3 years, right? This program is a little bit more specific, so I'll read it off and then you can ask questions. So each borrower must be a first-time home buyer. At least one borrower must be a first-generation home buyer and a California resident. So let's go over the definition. The first generation homebuyer definition is defined as a homebuyer who has not been on title, held an ownership interest, or has been named on a mortgage to a home in the U.S. in the last 7 years. Additionally, to the best of the buyer's knowledge, their parents do not have any present ownership interest in a home in the U.S., or if deceased, whose parents did not have any ownership at the time of their death in the U.S. So a lot of little small things to this definition. And CalHFA is very specific. You know, you have to meet the specifics of this definition. And, you know, some people think they're not eligible, but they actually are. So let me give you a scenario, and then I'll let Marissa take some questions. So, like, here's an example of a couple that can fit. Let's say a husband and wife. The wife was previously married and she owned a home, and she got out of the home 4 years ago. And they've been renting now, the new husband and wife, been renting for 3 years. And so she is technically a first-time home buyer, right? Now the husband, he's never owned a home, and his parents do not own a home as well. And so he is the one that's defined as the first generation home buyer. That is okay for the Dream for All. So after that definition, let me see if you've got any questions there, Marissa, or if you had any things you wanted to bring up.
We're good right now.
Awesome. Yeah. So feel free to put them in the chat and then we can answer them because there may be some scenarios, and sometimes I get stumped, but most of them I have them. And with this program, it's a little stricter on FICOs, where the other one can get into the FHA arena where you can get down to 640. This program's down to 680. If you fit into the low AMI, which is the home ready income limits, and it depends on your county, and Marissa can help you with that, then you can go down to a 660 FICO score. And the better the FICO, the better the situation with how much more flexibility with debt to income and how much purchasing power you can have. The second lien from CalHFA, which is great, instead of 3 or 3.5%, you're getting 20% of the sales price, or 150, depending on whatever is lower. And you can use that, let's say it's 150. You can use that for the down payment, and you can use it for closing costs. So, I don't want to confuse you too much, but you could, let's say, take the loan to value at 83% and take it all the way up to 103 and use 3% for closing costs and stuff like that. So that is available as well with the program. If you did do that, you would have mortgage insurance at the 83% LTV first. Most people come in with the 20% and take advantage of that and stay with no mortgage insurance, which is nice. Now with this phase one, we got 2 different types of buyers. We got the types of buyers where they were going for wealth building, and then we also got the types of buyers that were your typical first-time home buyer, tight on the money, that kind of thing. This type of program, this time around, phase 2, it's definitely there to help the first-time home buyers that are your traditional, aspects. I mean, we did a big chunk of the volume in the first phase, and I did get a lot of 1.2, 1.3 sales prices on this stuff, where the borrowers were contributing maybe a couple $100,000 and then using the state funds for the rest of their down payment and staying in the conforming loan limits. Now with this program this time around, they really do want to help the first-time home buyers. And so the max borrower contributions is 5%. So the maximum CLTV would go up to 105. So proposed timing with this, let's go over this, is kind of really important. It's not a first come, first serve. So everybody's like, oh, can I do it now? I got to get in. Don't panic, because Marissa's got it under control. She's got you down. She's going to pre-qual you. And so the timing on this is not first come, first serve. We're waiting for confirmation. We believe April 1st will be the release date, and there's going to be a portal. And what Marissa's going to do, and I don't know, Marissa, are you going to bring up the pre-approval letter or not?
Yeah, there's a specific pre-approval letter that we have to issue, right, yeah. Frank? And so I have a copy of that already when we go through the pre-approval stage.
So yeah, you'll get with Marissa. She'll work your math, make sure you're fitting into some of the questions that the Dream for All and CalHFA are asking you. And what they're going to do is April 1st, they're going to open up a portal. And in the portal, you will be able to go into this website with Marissa's pre-approval letter and her signing the form. And it'll have us on the top. And then it won't be a first come, first serve, which is great. So you don't have to panic. You'll go into the portal. You'll go ahead and register information. They'll ask you some questions. We don't know specifically, but we know basically they're going to be asking you some general questions that are kind of towards the guidelines. And it'll be open for 25 to 30 days. So that gives you plenty of time to go get in there and do your thing. And it's not, again, first come, first serve. So once the buyer has registered, what's going to happen is the state's going to they have actually a third party going through the portal to validate your information. So they're going to validate, if you kind of misrepresented or something like that, they'll be able to tell, and you just won't be able to get a voucher. I will warn you a little bit. There is a perjury clause with the when you register. So you want to be truthful. If you can't fit into this program, best to get with Marissa and get, into the My Home or other types of programs. But there will be a third party that will go in and validate that you're a first generation home buyer and that you fit all the parameters. And then what'll happen is they'll be after those 25 to 30 days, they'll release those vouchers. Now they anticipate roughly between 20 to 30,000 applicants, and it could be more, it could be less. It's a hard thing to say. But they do know how much funds they have available for the Dream for All. So they anticipate roughly 1,700 to 2,000 vouchers that get allotted. And again, you don't have to panic, because if you do get, the lucky ticket, great, it's awesome, but you don't have to panic. You're going to have 90 days to work with Marissa and her team to go shop for a home. And then you'll go in and she'll register that loan with the state with your voucher and reserve the funds with the lock. So you got some time, don't have to panic. These loans could close all the way into October, actually, if you're getting some new construction or something like that. So after that, I'm going to open it up. Any questions, Marissa, or anything you wanted to comment on?
No, but I did want to make a comment on that. So you guys, this is where the pre-approval stage is very, very, very important, because it is a lottery system. So we need everything from every buyer. We need to have you pre-approved in March so that we can go ahead and submit for this particular program. We'll qualify you for both. We'll do the My Home and we'll do this program, because you need to have a backup offer, because you're not guaranteed the funding for this. That lottery system is in effect, right? So how long did they mention how long it was for them to choose the lottery applicants?
Yeah, so they're going to keep at this point, and there could be changes, because I've been on these 7 hours of videos and they have these calls every month, and they've made changes every month, which is great, because they listen to the people and then they make things better. And so that's a good thing. So a lot of this information is from January and they haven't released any new information. So it could technically change, but the portal is planned to be open 25 to 30 days. So you could be the person that goes in on the 25th day. You're not going to be treated any different than the person that gets in the first.
Right.
So, and then let's say, for example, maybe 5 to 7 days later, they start issuing the vouchers. Then you have your 90 days to go shop for a home and then reserve funds with your lock. I will give you some background information. I did listen to the 7 videos, and you guys can go pull these offline if you like. They're on YouTube. But you will see the states kind of trying to help people that didn't get to take advantage of phase one. Phase one, there was groups that did really well with phase one, and geographical areas that did really well with phase one. For example, the Sacramento and the Central Valley did really well with phase one. And also in Southern California, the Inland Empire did very well. So they have mentioned on this that they do really want to help out some of the underserved areas that didn't do well in phase one. So some more closer to the coastal, they're going to try to help out a little bit more with the algorithms. How they're going to do that, they didn't really say, but they did mention that on multiple occasions, and it is on the announcement. The other thing is with some of the minority groups that didn't perform very well in the first phase. There was some groups that did very well, but there's some that didn't do very well. The Latino community and the African American community did not do very well in phase one. And so they're hoping that the algorithms will be set up to help them a little bit more in phase two, so they can distribute some of the things in phase two a little bit more equitable. So let's go on to the next slide. Is this for the entire state of California? Yes, it is for the whole state of California. Yeah. There is some things you'll notice when you look at the right, there's a little bit more restrictive in income for the Dream for All. Now, it's not going to be too far off with the sales price range, because you're getting more from the state, right? So these sales price ranges here are going to get you closer to the same, pretty much where you were. I would imagine the 500 to 600, 700,000. These are all going to be available to you and give you a little bit more buying power with this Dream for All program. We talked about the pre-approval letter. Marissa will dial you in with that. There is no sales price max because of the LTV, CLTV restriction and the income limits, you're going to see some of the sales prices are forced to be kind of capped out. This program, which is different from the My Home, it does allow you, let's say, for example, 5 years down the road, rates come down and you wanted to rate and term this loan and keep your second there. That's okay. It is allowed on this program. Whereas on the My Home, you actually have to pay off that first, second, and third mortgage when you refinance or sell the house. So that's a great thing about this Dream for All program. I want to take a little bit to go over the shared appreciation terms. So any questions, Marissa, before I go into this?
Nope, you're good.
Okay, great. So don't freak out and don't think that you have to memorize this off the slide. It can be a little confusing the first time you look at it. And most down payment assistance programs have nothing's really for free. You know, it's either you're paying the simple interest on the My Home, or with this program, it's appreciation share. So with this program, it's either 15% or 20% appreciation share that you're going to pay. If you got low, income into the home ready limits, then you only pay 15% appreciation share. If you're regular, you're going to have 20% appreciation share. So how does that work? Let me give you an example on the next page. Let's go to the next page, Marissa. So in this scenario here, the state's saying, hey, this buyer is going to buy a $500,000 house. That first mortgage is going to run in at $400,000, and then they're getting the $100,000 with the Dream for All from the state, right? And there's a certain amount of time goes by, 5 years, and there's appreciation in this. So you have that number there at 140 with the appreciation, and that, let's say they're going to sell the house. So at 140 with the appreciation, the state's going to get back the 100,000 when they pay everything off. Plus, they're also going to get that 20% of the appreciation of the 140, which is $28,000. So that's kind of how the appreciation share works. It's not too complicated. There's maybe a little bit more to it because you have the sales price and things like that. And if you're refinance, you would have to, if you did a cash out refi or something like that, you would have to pay the state back the appreciation share and pay the Dream for All loan. But again, the goal of this is to get you into the house that you want. There is no payment for these seconds with the My Home. There is no payment on the Dream for All second. Those are silent seconds. They just come due when you sell or refi. Any questions that we've got right now, Marissa?
No, but I do want to add to this.
Yeah, go ahead.
A lot of people that I spoke to think that, oh, this is a bad deal. And I admitted to when I first heard about this program, I was like, don't know how I feel about that. But these numbers really break it down. When you're getting so much money as a down payment, you're paying a lot less for your home because your loan balance is a lot less. The best part of it, it's borrowed money at a 0% interest rate. So there is no interest. So to be able to share and give back 20% of the equity is still a really good deal because you have to be forward thinking in what they're going to be utilizing these funds in the future. This is their way of wanting to build the program to be able to lend to future generations. So this money will be given and put back into the program for future use for eligible homeowners. And that's one of the reasons why they took this program and created it, that you would be able to resubordinate it. So if you have, an interest rate of, 6% and the rates go down to 5% and you refinance, you can resubordinate that loan, which means you don't have to pay it off yet, one time before selling or refinancing later, before you have to pay back what you borrowed and just that 20% of the appreciation value. And just to be clear, that's from the purchase price to what the value is.
Perfect, Marissa.
One question here: what if they don't sell the house when it's paid off? When they have to share that is when their mortgage is paid off. Their first
That's
mortgage.
correct. Yes, that's correct. So if you had a 30-year term on your mortgage, and you paid, then you finished, then that's when you would have to finish up and pay back the appreciation share. And I think that with these types of loans, it's very key to watch how things go. And it's very important for you to work with your agents, work with your loan people, and Marissa, because, if we tell you that the appreciation share is going to go back to the state, and that wherever you're at, it's going to go crazy in appreciation, it's important for you to get with Marissa early. If you come with the means to go ahead and clear this all up and get yourself dialed in with a new loan and be ready to go for the future and clean this up. So important for you to keep in contact with Marissa as years go by, so that you can, remove this stuff from title and clear up. So, if you did hold on to it for 30 years and, if you see normal appreciation, you could pay a pretty good share back to the state, So, things to look at. It's not saying it's a bad thing, but, it's something you want to look at. Marissa,
We do
you're
have a
on.
couple questions here. Yeah. Is it true if you pay more on your mortgage, it pays off your home quickly and you have money left over? It does. Anything that you pay towards your mortgage additionally can go towards principal balance to pay your loan off faster. You don't necessarily have money left over. I'm not sure what you mean by that. You can clarify that with another question if you want. Lionel, can the homeowner take out a loan like a home equity line of credit? Yes, they can. If you're talking about another mortgage on their current property, they can't pay it off. So if you purchase a home and you purchase a home, you utilize this down payment assistance program for the shared appreciation. You can refinance, which means take out a loan to pay off your first mortgage once. And then that second time, if you wanted to do another refinance, you would have to, at that point, pay off that shared appreciation. But I want to be clear, when you say take out another loan, that loan that you take out would have to be okay with being in third position, right, Frank?
Sure.
So
Yeah, you got it.
because the shared appreciation portion, you have a first mortgage, you have a second mortgage that has to be paid eventually. So that third loan that you take out, if you're taking a home equity line of credit, they would have to be okay with going in a third position behind the Dream for All and the first mortgage product.
Yeah,
Okay.
and it's another good thing to think about, like, it's the goal for the program with the state is to, develop a home ownership and wealth for future for families that, didn't have the opportunity. And, it's not set up, if you convert it to a rental or something like that, they have the option of calling the loan due and payable because again, they're trying to create home ownership as a primary residence. So you want to be careful with that. If your intentions are to do that, probably want to meet with Marissa and make sure you guys, get the right path for how your goals are for the future. And then I don't know, the only other thing I wanted to cover with the process, you can go to the next page real quick, because I think everybody has this, with this time around, the first part, phase one, everybody was panicked because if you didn't reserve funds and reserving funds means locking, that's what it means. And so when we did the first round, everybody was panicked to lock. I mean, the last day of the program, I actually had 40 lock requests come over on loans that were submitted and some of them were approved. And some people just waited, and which was a big mistake, right? And so of that day, only I had 2 that ended up getting locked because the state couldn't handle it, right? So that is not a problem. I want to be clear with you on this phase. It's not first come, first serve. So you have those 90 days to go shop for a home. And then once you get into contract, let's say you get in on day 85, Marissa's going to go in, she's going to register the loan and run the DU, and then she's going to go ahead and have the ability to reserve those funds before we hit the 90 days and lock. And it's as simple as that. And it doesn't even have to be approved with us to lock. It only has to be in our system with an AUS and approve eligible, and we'll need that voucher. So simple stuff there. And that's about the basics. I mean, Marissa, you can add if there's anything else you wanted to add that if I think I
Absolutely. Most people are having the question about, one second. Most people have the question on when you get your voucher. When you get your voucher, you have X amount of days to shop and get into contract and for us to register the loan with CalHFA. That's where the 90 days is coming in, right, Frank?
Yes. So at this point, that is the plan. I mean, they wavered at, at first they did talk 60 to 90. Right now the number is 90. So, if you get, let's go over a little bit of a timeline. Let's say you go into the portal on April 5th and you register, you have Marissa's pre-approval letter, and you wait the 25 to 30 days that the state has the portal open. And let's say they issue the vouchers and you're one of the lucky ones that gets them, in May 15th. Let's use that date, for example. So from May 15th, you got your voucher, you have 90 days to go out with your agent and Marissa's team and to, select a property and go into contract. And then we want probably, I think around the 85th day, to give yourself a couple days, to get that thing reserved with the state. And then she has, plenty of time, 60 to 90 days after that to close the loan, depending the type of loan it is, whether it's new construction or just a regular loan. So like I said, these things could last all the way into October. So hopefully
Mhm.
that gives you a little timeline there.
And then the other question that people are having is April 1st, they open up the portal. How
Mhm.
long before they know if they made that lottery pool?
So it's not first come, first serve. So their goal is when they open the portal, right? You're gonna kind of have to wait. So it doesn't matter so much that you went in the first day. If it was me, I'd probably try to get in early, because who knows how they're gonna do this. But they are going to go and do these background checks, right? For those
Mhm.
25 to 30 days. And so until that's all done, they're not going to issue those vouchers. So
Right.
better if you're in there a little early and they see that you've gotten the green light. Now they're not going to communicate that anything to like that to you. You're going to have to wait until they do the release of the vouchers.
It's kind of like a hurry up and wait type of situation, right, guys?
It is, but it's nice this time.
Yes.
It's not like
Yes.
panicked. You're going to all have a chance to go into the portal as
And
long
you
as you
have to
do it.
remember your credit report and your income documentation, all of that is good for only a certain amount of days. So,
That's true. Yeah.
a lot of loan officers were out there saying, hurry up, let's get pre-approved right now, right? But credit is only good for X amount of days, and then you're going to
Right.
hurry up and wait a little bit longer. So it is good to take a look at everything and get the roadmap started. You need to be prepared as far as is your credit where it needs to be? Do we need to get you up a few points, before that April, May deadline? Because literally you're going to be looking in May sometime, maybe even June, who knows, right? We just really don't know. And every month they're coming out with new updates to try to make it a little bit more streamlined for you guys. We did have a couple more questions. Will there be deficiency judgment just in case the home goes to short sale? That is a good question. The the way everything is headed right now, I don't know that short sale is something we'd have to really worry about, but just in case we did, it would be treated just like any other short sale process, right? So
Yeah,
yeah.
and I think it is important to know from the appreciation share, because let's say, for example, and let's just not say for short sale at this point, but let's say you sell the house 5 years and, let's just say, unfortunately, there's no appreciation in your marketplace. You do have that second that's still on there, but the state won't collect the appreciation share because you didn't have any. So you would
Right.
just pay back that second lien, that's the silent second, and you wouldn't pay any appreciation. So
That's
that
right.
could happen for sure.
Yes, yes, it could. Does the loan allow for a condo?
I'll answer this one a little bit because I
Mhm.
think I do these loans and get them in all the time. And I think because of affordability in certain areas, especially since I told you the state is trying to help more of some of the coastal areas in this phase two,
Yes,
with those income limits, you may only be able to do condos, and that's okay. So you'll want to work with your real estate agents and Marissa's team to make sure, in this case, for the Dream for All, that it's a Fannie Mae warrantable condo. So those kind of
yes,
questions will, kind of be looked at earlier. It's not too much different than doing any other loan in that sense, but you'll want to work with them to make sure that the condo is warrantable so that it's doable transaction. But nothing too scary with the condos.
yes. Pretty much yeah, wardable condos are the big thing. You got to make sure that it meets that requirement. But also, the programs, the types of homes, I'm sorry, the types of properties that you will not qualify for are going to be the multifamily on this. Okay, so no multifamily residence properties. Okay, is the appreciation calculated on the original purchase price versus the sold price when the owner sells, or is it based on the sold price less paying off the mortgage? So they're going to pay back they're going to pay back what they borrowed. And then when they pay back what they borrowed from that sales price, the original sales price that they purchased the home for, whatever they end up selling it for, 20% of that difference.
Yeah, and she got it right. And if it was a refi, for example, CalHFA would, know that they're going to get paid off, and they would come up with a value And that would be the assessed of what the appreciation share would be. If you, let's say, for example, you did a refi out of it, that could be an option too, other than the
Right.
sale, for sure.
And
Good job.
I just want to clarify, mobile homes and manufactured homes are
Oh,
two
yeah.
different things, you guys. Agents get this confused all the time. Mobile homes are more like trailers, right? They're mobile, they will move. Manufactured home on permanent foundation is allowed. Yes, correct, Andrilli. Quads, triplex, duplex, those types of properties, no, on CalHFA. Okay. All right, what's next?
That's it.
That
You did
that was
awesome.
it.
Yeah,
That was
you did
it.
awesome. Your voice and my voice, I think, are both gone. I think that, you know, the things that we're seeing out in the industry, and I'm not going to cover this slide, but I do want to make the agents specifically, you know, aware of the stuff that we're seeing as well, and stuff that you need to become experts with, because we're the push for the millennials and the new buyers, you know, because condos are not always Fannie Mae or FHA approved. We'll even do, you know, FHA single unit approval, stuff like that. Something you want to become aware of. So I think you should get with Marissa to learn on that, because affordability is really a challenge, you know. Manufactured homes on permanent foundation and condos that are not FHA approved are things that Marissa can help you on. And so other things that we do, and we can help you on as well.
Yes. So you guys, quick recap, okay? For a home buyer, it's all about their roadmap to home ownership. What does that look like? We have to remember that not every home buyer is in the same financial situation. So we have to do a consultation. We need to get to know clients based off what their income situation is, what their asset situation is. And a lot of people think that you need to have money to buy a home. That's not necessarily the case, you guys. We will work with whatever you have and strategically plan affordability for your unique situation. So if you don't have any money, then we will pre-approve you for your maximum. We'll go over the qualifications of that. We'll go over the payment range that you're comfortable with. We will plan it out, and then your real estate agent and I will work together to submit offers for you to help you get into a home with what your unique situation is. For non-FHA approved condo complex, will there be a spot approval? Yes, we do have the capability to do spot approvals. So that is something that is possible that we can talk about as you guys are out there looking. Okay, does anybody else have any questions for Frank or I before I let you guys go? Please know that I am going to post this on the web. So if you're a real estate agent, you're going to be getting a copy of it. You can take this information, you can share it, send it to your clients. If you are a borrower that joined us today, please reach out to me. Let me know if you have any questions at all. You're going to be getting an email with all of my contact information, and I will send you right back to your agent who sent you over to me. And we will talk together and to make sure that we set you up for success. You're welcome, Florence. Okay, you guys, thank you. Frank, thank you so much. You are
Oh,
such
great job, Marissa.
a
Thank
wealth of
you.
knowledge, and I appreciate you.
All right, you guys have a good weekend.
Okay, bye everyone. Have a blessed weekend.